Welcome to the deep dive. Navigating today's financial news, it can feel like a lot, just constant market chatter, right? So today, we're trying to cut through some of that noise. We've got this really interesting piece of analysis here. It's a market valuation snapshot dated August 1st, 2025. And we're going to use it to, well, get a clearer picture of where the market really stands right now. Think of it like taking the market's temperature. Our goal, to unpack two really key valuation metrics from this snapshot. We're talking of the Buffett Indicator and the Schiller CAPE. We want to explore what these numbers actually mean, what they might imply for your future returns based on history, and also what's pushing them so high.
And what's really striking right off the bat in this snapshot is the conclusion. It says we're in significantly overvalued territory. It's not just a feeling they have. The data is specific. You've got the Buffett Indicator sitting at 208.7%, and the Schiller KPE is at 38.2. Those are pretty eye-popping numbers, and we need to understand what's behind them.
Okay, yeah, let's definitely unpack those. Starting with the Buffett Indicator. It's a classic, right? Favored by Warren Buffett, hence the name. Basically, it's just comparing the total value of all U.S. stocks, the whole market cap, to the size of the actual economy, our GDP. Simple concept, really. And historically, looking at the analysis here, a reading around 100%, that's generally considered, fair value, ballpark figure. But here's the kicker from the snapshot. When that indicator goes above 150% and stays there, it's historically led to, well, pretty underwhelming returns over the next 10 years, below average.
That's the historical pattern. And this snapshot, it was updated very recently, July 31st, 2025.
Yeah.
It shows the Buffett Indicator right now at 208.7%. So you can see why the report slaps that significantly overvalued label on it. It's way, way above that 150% historical sort of warning level.
It suggests quite a bit of market froth compared to the underlying economy. Yeah, 208%. That really hammers home the significantly overvalued point. Okay, let's switch gears slightly. Let's look at the other big one. The Schiller KP ratio, that's the cyclically adjusted price to earnings. This one's often seen as maybe a bit more robust because it uses 10 years of inflation-adjusted earnings, so it smooths out those wild short-term swings you get in earnings during booms and busts, gives a clearer long-term picture, and the analysis gives us a benchmark. The 20-year average for the KPE is around 27. That's our baseline.
Exactly. And the current reading, again, updated July 31st, it's 38.2. Now, what the analysis highlights is that this 38.2 is a full 41% above that 20-year average of 27. And maybe even more telling, a reading this high puts us in the top 10%, the top decile of all readings since World War II. That's rare air. The report specifically says a print of 38 hints at compressed forward returns. So for you, the listener, that's another strong historical signal about potential future headwinds.
Okay, so both indicators are flashing pretty bright warning signals, historically speaking. The big question for anyone listening is, what does this practically mean for your money, for potential future returns? Well, the snapshot gives us some historical data on that too. It looks at median returns after these indicators hit high levels. So when the Buffett indicator was at 200% or higher, historically, the median return over the next 10 years was somewhere between 0% and 2% per year. And get this, that includes dividends, 0 to 2%.
Wow.
Yeah. And for the NORG AP ratio, when it's been 95 or higher, the historical median return was about 1% to 3% annually over the next decade.
So those historical numbers are pretty sobering.
They are. They're not crystal ball predictions, obviously, but they show a strong historical tendency. Suggest, it might be tough sledding for just buying the index and expecting great returns from here.
But does overvalued automatically mean a crash is coming next week? The analysis adds some nuance there, right?
Exactly. It's really important. The report says, and I'm quoting here, elevated valuations do not guarantee an imminent crash. Okay.
But they raise the bar for growth and leave less margin of safety.
Okay. So what does that mean, raise the bar?
It means that for the market to justify these high prices and still deliver good returns, dark companies need to deliver really strong earnings growth. The economy needs to perform exceptionally well. Basically, things need to go perfectly.
Right. Priced for perfection, less room for error, less margin of safety if something goes wrong.
Precisely. So for you, the investor, it suggests thinking about resilience, maybe diversification, and understanding that future gains might be harder won. Turbulence could hurt more.
Makes sense. It shifts the risk-reward calculation.
Definitely. Okay, so if valuations are this high, the next logical question is, why? What's driving this? The snapshot actually identifies three key drivers. First one's pretty visible. The mega-cap AI and cloud rally.
The big tech dominance.
Totally. Market value is super concentrated in the top, say, 10 companies. Many are riding this huge wave of AI and cloud computing excitement.
And that concentration itself is a factor, isn't it, if a few giants stumble? Absolutely. It creates its own kind of risk for the broader market. It's not a wide, broad-based rally in the same way.
Okay, what's the second driver?
The second one is real rates still near zero. Real rates meaning interest rates after you account for inflation.
Right, the actual return you're getting.
Yeah. And when those real rates are super low, like near zero, it changes how investors value future profits. Future cash flows look more valuable today, which helps justify paying higher prices, higher multiples for stocks right now.
It's the discounting mechanism at work. Low rates inflate present values.
Exactly. And the third driver mentioned is fiscal impulse.
Government spending.
Basically, yeah. Record federal deficits pumping money into the economy. This helps boost nominal GDP, that's GDP before inflation adjustment.
Which directly impacts the Buffett indicator, since GDP is the denominator.
Correct. So that government spending can sort of artificially prop up asset prices and that GDP figure, contributing to the high valuation reading.
So it's this mix. Tech euphoria, easy money conditions, and government spending all converging. It really highlights a unique, maybe complex market setup right now. That tech concentration especially feels like a potential vulnerability.
It does. To put today's levels in perspective, let's do a quick history check using the data in the snapshot. Compare now to past peaks.
Good idea. Context is key.
Okay, back in 2000, the dot-com peak. The Buffett indicator was around 150%. High, but not like today. But the KPE ratio was way up at 44.
44? Wow, okay.
Then 2007, right before the financial crisis, the housing peak. Buffett indicator was about 130%. KPE was 27. More moderate, actually.
Closer to its long-term average then.
Right. Then jumped to 2021, post-COVID stimulus boom. Buffett indicator hit a record 240%.
Whoa.
And the CPE got to 38.
Okay, 38, remember that.
And now, today's snapshot, August 2025. Buffett indicator at 208.7%, so down from the 21 peak, but still very high. And the CPE, 38.2.
Huh, that's fascinating. So the CPE today, 38.2, is basically the same as the 2021 peak. And it's not drastically far from the dot-com peak of 44. By that measure, we're definitely in nosebleed territory, historically speaking.
Seems that way.
But the Buffett indicator, while still extremely high at 28%, is actually lower than it was in 2021. So there's a bit of a divergence there, both screaming overvalued perhaps, but maybe reflecting different things.
Could be. It paints a nuanced picture, doesn't it? History doesn't repeat exactly, but these parallels and differences give us valuable context for today's risks.
Absolutely. Tells you we're in an unusual spot.
So, given all this, the high numbers, the potential headwinds, the historical context, what's the practical takeaway for you listening?
Well, the snapshot itself actually provides some guidance. Not investment advice, but guidance on using the information. It includes a very clear disclaimer. It says, this report is for educational purposes only.
Crucial point.
And reflects public data that may be revised. It does not constitute financial advice. It couldn't be clearer. Right. They're giving you data and analysis, not telling you what to buy or sell.
Exactly. And it adds, perform your own due diligence or consult a registered advisor before acting. And also, we may hold positions in assets mentioned. Full transparency.
Which is exactly how it should be. It's about empowering you with information, not making decisions for you. And interestingly, the report even points you towards tools for continuing to monitor the situation.
It does.
Yeah, it mentions an iOS app specifically called Buffett Indicator. It says it's for getting real-time market temperature readings and even push alerts. So the report itself is encouraging ongoing tracking using the very metrics it discusses.
That's helpful. So they're not just dropping the data and running.
Seems like it. Providing tools for ongoing awareness.
And, speaking of resources, the snapshot itself, sort of in its final notes, points to its own ecosystem, too. It mentions the Deep Value Investing podcast and YouTube channel for weekly deep dives on macro and valuations like this one. Yeah. And it even asks folks to like and subscribe on Apple Podcasts, Spotify, YouTube, and mentions grabbing a value investing reading list from the episode description.
So they're providing the analysis, the tools to track it, and pointers to more content if you want to go deeper. All part of that educational framing.
Exactly. It's all presented as part of the report's own wrap-up and guidance. So let's try and tie this all together then. What's the core message from this August 1st, 2025 snapshot? Essentially, it's signaling that U.S. stocks look significantly overvalued based on both the Buffett indicator and the Schiller CPE. And history suggests that could mean lower or compressed returns over the next decade or so. It's really a call to be aware, to understand the current market dynamics with eyes wide open.
Definitely. It sets a specific context, which leads to a final thought, perhaps. Given everything we've discussed, the high valuations, the drivers, the historical parallels, even the way the report itself guides you, what's the one key signal you might watch most closely in the coming months? Something that could either confirm these valuation concerns or maybe challenge them, and maybe for you listening. How does understanding this snapshot, including its own disclaimers and guidance, influence how you approach financial information and your own homework, your own due diligence going forward?
That's a great question to ponder. Hopefully, our deep dive today has helped streamline things, giving you a clearer understanding of this important market snapshot. Our aim was to empower you with that information so you can navigate things feeling more informed. Thanks for tuning in.